Hi, well, welcome everybody. This is the second of the series of short recordings that we're doing at the moment to talk about what's going on in markets. I'm Tim Gregory. I'm the Senior Fund Manager of the Vermeer Global Fund, and I've been managing that fund for over 5 years. This is Charlie Fricker, the second of a four-man team that runs the fund, and Charlie's been working with us throughout that the 5 years that the fund's been going. And what we thought we would do today was to talk a little bit about the results season, because it has been, as ever, very interesting, and one of the more volatile periods in terms of some of the stock price reactions from some really sizable companies. And so why don't we start with you, Charlie, and talk about some of these mega cap stocks that have reported earnings, and we've seen some pretty amazing moves. Netflix, Meta, and then obviously on the other side of that, Amazon had good numbers and rallied strongly. But why don't you start off and say a little bit about what your thoughts were on the Netflix and Meta numbers?
Yeah, I think what you said is exactly right. We've seen unbelievable volatility in earnings over the last kind of 4 weeks or so, and especially within the mega cap tech companies. We've seen trillion-dollar companies move in 20-25% increments plus and minus, and it's been pretty extraordinary. With these companies of this scale trading with more volatility than penny stocks, and the reaction to earnings has been interesting in terms of if you've delivered, you perform well, and the share price have reacted accordingly. Whereas if you've underperformed or had a difficult quarter, you've been treated pretty badly. There's no forgiveness in the market seemingly at the moment. And I think specifically on Netflix's numbers, we talked in our last video about what's going on in the streaming industry in general. And I think the market was concerned about what's going to happen to the overall TAM, what's going to happen to the overall streaming world, and has the TAM, the addressable market for these guys, shrunk, or is it more competition? They're fighting over a smaller piece of the pie, so to speak. But overall, I think Netflix's results were fine. It's just a reevaluation of where this business is going to go, and we've talked in the past that people should be perhaps focusing on more traditional metrics for the company anyway, rather than just pure subscriber growth numbers. So that's my view on why the shares reacted poorly. They bounced a bit with some activist involvement coming in on the back of the pullback. Yeah. And for Meta, it's totally different reasons as to why that business has really struggled post its results and has continued to struggle following that. We've had, they called out daily active users declining for the first time in the company's history. They talked about increasing competition, especially from TikTok. They were naming a lot of those brands on their earnings call, whether that's for the benefit of regulatory reasons to try and say, well, look, we're not the dominant platform, we really are. And then on the back of that, they're investing aggressively for the next leg of the business. And the market's trying to take the assumption as to where what's going to happen in the interim until the metaverse maybe comes to fruition. And maybe Facebook did know about 6 months ago, and they announced the change from the name change from Facebook to Meta Platforms, that actually our core business is going to slow. We need to reposition the company, and they got there before investors had. And maybe that's the conversation investors are having amongst themselves at the moment as to where is this business going to be moving forward. But on the flip side of that, we've seen some tech companies that have delivered good results, Microsoft, Apple, that have performed pretty well on the back of their numbers.
Yeah, I mean, if Microsoft has been one of the biggest positions in the portfolio, throughout the 5 years that we've been managing it, and it never ceases to amaze us, I think, when we have the results, just how strong the franchise is, just how, even if there has been some pull forward of demand from COVID, and there's no question that there has, that despite that, the company is sustaining very high levels of growth at tremendous margins and continuing to invest very aggressively for the future to further strengthen its position. So, Microsoft's results were great. The valuation is quite stretched, and I think, markets rightly are starting to refocus on valuation. So, I think it's no point pretending that Microsoft is a cheap share, but, based on the growth it continues to deliver and the sustainability of its franchise and its ability to continue to invest, and of course, sort of controversial acquisition of Activision Blizzard, and see whether that gets the go ahead or not. The company seems to still be going from strength to strength, doesn't it? And I think similarly with Amazon, who've been investing very aggressively, with Alphabet, whose search business continues to be absolutely dominant, and YouTube begins, continues, I should say, to gather momentum as a relevant source, of advertising and media going forward. So it's been really interesting. And, one of the most interesting results, I think it was last night, we had the numbers from Disney, which, everyone went into quite bearishly. So I think everyone was thinking, goodness me, given what we saw in Netflix, what's this going to look like? And actually, the subs were a bit better than expected. But what really stood out to me was, this time last year, the parks business, because of all the COVID related problems, 3.5 billion of sales, 100 million of losses in the quarter. Roll forward 1 year, over 7 billion of sales and 2.5 billion of net income. So absolutely astonishing numbers. Whilst the business is still under COVID protocols, limited capacity, parks not open the whole time, cruise liners only just getting going. So, really stellar, I thought, performance from that part of the business. And, we'll see how they go forward, with the DTC business, which has been such a focus of attention.
Yeah, well, I mean, it really highlights, and we've talked about this a lot over the course of the 5 years of the fund, that pricing power is really important.
Absolutely.
And, one thing that Disney has shown through is that the Disney brand is incredibly strong, and that allows them to drive pricing, especially in the parks.
Yeah.
With a lot of our other businesses as well in the luxury space, we've seen some brands raise prices by up as much as 60%, and 3 or 4 times over the year. Ferrari, one of our favourite companies, has got almost the ultimate pricing power.
Yeah, absolutely.
And it's been a theme. Companies that are able to offset any increases with pricing have performed quite well.
But I think one of the sectors that's been really tricky, that is perhaps surprising, has been healthcare, because normally you associate that with stable growth environment, aging populations, all very good drivers for those businesses, and it's been an industry we've generally been long of, with quite a variety of different positions. We've seen some amazing volatility on the results of those companies. I mean, what do you think is the key driver behind that?
I think for the tech companies, we don't own Netflix, we don't own Meta, so we managed to avoid the falls there. But we do own businesses such as Zimmer Biomet and Olympus in the medtech space, absolutely. Which are, especially Zimmer, the majority of their sales come from elective surgery, which has had basically a full-on pause for 2 years, and as a result of that, they've really struggled. The business was in a great place exiting 2019 with the new management team. They got sales growth up to nearly 4%, which in their industry is pretty good. And then COVID came through, and people stopped going to hospital for elective procedures, and so they highlighted that on their recent quarter. I think they kind of level set expectations as to what to expect moving forwards now. Shares reacted poorly to the reset, but over the subsequent 2 days, the shares have pretty much got back all their losses.
But that's not really been the case. I mean, that's true for Zimmer, but what about Olympus, where, a stock perhaps a bit more loved by the Japanese investing community because the activist investors have been involved? That stock fell 19%. I know it's rebounded since, but that's an astonishing move for a pretty stable business that didn't even downgrade their outlook.
No, it didn't downgrade full-year guidance. Historically, Q4 has been stronger than Q3, so the cadence of earnings was perhaps more expected. But yeah, it was hugely surprising move. As you said, it's got back 10% of the losses in the subsequent 2 days, but just highlights the volatility of earnings in what traditionally healthcare is classed as more of a stable sector. And I think it's been interesting to gauge how the more reopening type traders performed over the last couple of weeks, with initial reaction to the results being negative, and then people sitting back and looking at a longer term view and going, well, actually they've level set expectations, these companies now. The economies are going to reopen, procedures are going to get back to normal, and the setup for them over the next 12-18 months is actually much better, and looking more towards the medium to long term rather than just on what the quarter was and what they're actually conservatively, I think, guiding for.
And that's been helped, hasn't it, by a slightly better commentary around US hospitalizations and the COVID data and changes to policy. But looking at the other side of that coin, one of the stocks that we've been great fans of, again, for pretty much most of the time that we've run the portfolio, Danaher, one of the great businesses that no one's ever heard of, they have been a major beneficiary, admittedly from a sensational acquisition that they did a number of years ago, of COVID testing. Where now for stocks like that? Because they've been a great investment, have had perhaps arguably some really supernormal profits from that.
Mm-hmm.
How difficult do you think it is going to be for stocks like that to perform through 22 and beyond when there's been such a pull forward of demand?
I mean, there's no doubt that there's a balance now between what companies might be saying for earnings are going to be this year and what the investment community is perhaps perceiving as they come off this kind of elevated level of earnings. And I think for Danaher specifically, they've obviously had the benefits, as you said, from a huge amount of increases in testing, but they've then moved forward and developed that rather than just a pure COVID test. They've pushed it to a 4-in-1 test, which tests for 3 other things as well. They've got this much greater installed base of testing equipment that all these healthcare companies are telling governments and healthcare facilities, please use all this equipment that you've got in the ground now, so to speak. You know, test people for diseases to treat people earlier and catch disease earlier. So there's that to contend with. But what we found is that the good companies who forethought that we're going to have this kind of transition year when there's going to be a gap in earnings have utilised all the additional cash they've generated over the kind of the good times for them operating as a business to invest in the next leg of their growth to plug that gap. You know, with what Danaher has been doing, and you know, we talked about mega cap tech earlier with Microsoft doing several deals and the firepower those businesses have got now. So I think it's not just the medtech space. You know, Pfizer had results the other day, and the market is now thinking, well, a lot of your earnings has just come from your COVID vaccine sales and your COVID therapeutic sales. You know, where's your pipeline going to get to?
Sure.
And where for them it's well, you've got to prove it to the market now. Danaher has proven that they can execute, and I think that they can continue to deliver. But all these companies have all had to be dealing with huge increases in costs. It was a theme amongst earnings season, is the level of cost inflation and expenses coming through a lot of these businesses, and we've seen that across lots of different sectors.
Absolutely. I mean, funny enough, we were just doing, weren't we, today, the results call of Unilever, which has been a more recent addition to our portfolio. And, you know, management there was saying that 700 basis points of gross margin impact from cost inflation that they're offsetting partially by higher price, which is sort of phasing in, and other cost savings that they're making. But there's astonishingly unprecedented levels of inflation that these companies are having to deal with. And, you know, it's not just consumer goods, it's right across all industries, isn't it? And I think how we look at our companies, how we deal with that going forward, how the markets respond to that, all at the same time as central banks are normalizing policy, raising rates, trying to work out what rates should be when you've got inflation is growing at the rate it is. At the same time, trying to work out how much of that is, and dare I say the transitory word, because of these supply chain and cost pressures, and how much that's going to roll out and what rate should go up by going forward. And obviously that's, you know, very much framing the way we're thinking about our policy, as always, you know, looking at the macro, looking at the big drivers, whilst looking at the individual performances of our companies and how the managements of our businesses are really, you know, helping to offset problems that are coming from all these pressures. And it is, as always, noticeable that the best managed companies seem to be dealing with these pressures better than most. And I think that's why we focus the way we do in the portfolio, and why, even though we see lots of opportunity in growth, value, some more staple businesses, you know, like Unilever, which you mentioned earlier, we see plenty of opportunities all over the market, but quality management is clearly really important to manage our way through what are quite difficult times.
Yeah. I think the one thing earnings season has proven is that businesses in any industry, in any sector, if you deliver good numbers, your shares can perform well.
And it has been, you know, a very volatile environment. But, you know, I think, to your point, you know, the week we had the big announcement from the Federal Reserve, simultaneously we had results from Microsoft and Apple. Markets had been really poor. Those good numbers were really able to help stabilise the market, weren't they? And I think that is going to continue to be really important going forward. Okay, well, we'll leave it there. Thank you very much for tuning in. We'll be back quite soon with our next update, and look forward to seeing you all then. Thanks very much.